I only stay in the lane that I understand. You say invest in what you know. That's your number one. That's my number two. Stay in
Okay.
your lane.
Mm-hmm.
Stay in your lane. I have fixed and flipped 100 million. I've lent $1 billion. I know my space very well.
All right, guys. Hey, welcome to another episode of the Practical Wealth Show. Where do you find yield in real estate today? All right. So our guest, Mr. Todd Pigott, the managing founder of ZINC Financial, we're going to answer that question. And really the topic specifically today is why debt funds versus equity funds in today's market. And so let me tell you a little bit about Todd. So he's the principal and president of ZINC Financial and the ZINC Income Fund, founded in 2007. He's a licensed lender, having originated close to $1 billion in loans. He's how much you say you a lot of I'm gonna let you tell the flip.
So, no, I fixed and flipped over 100 million myself.
Himself. Okay, so this guy, a lot, because our listeners are real estate investors, done what you've done. And so he started ZINC Income Fund as a vehicle for investors to benefit from the lending that his company does. And he's held the position of the president of one of the largest interior maintenance companies in California, Central Valley. And he's just a good guy. We've been talking for 10 minutes before we got started. So he's excited as I am. I said, dude, we need to start recording because we're wasting all this good stuff. Todd, welcome to the Practical Wealth Show. I'm excited to get into this with you.
Hey, Curtis, thanks for having me today. And I'm hoping that I can provide some value and insight to your listeners today. I consider it a privilege to be on here and share my story.
Well, as well, you should. No, just kidding. I'm very silly. I just had to warn you. So tell him what I didn't tell him, and then how you kind of got yourself where you are today. And then I want to talk about, get into our topic a little bit, because I think it's absolutely fascinating. And I think it really fits with the message of Practical Wealth.
Yeah, so the program today is about, the difference between a debt fund and an equity fund for those listeners who want to passively invest in real estate, right? And so that's the topic. So how did I get here? Originally a native of Southern California, my dad was vice president of Pacific Life Investments out of Newport Beach. Moved here in junior high, and I went to school, and I went to Fresno State, got my degree in construction finance. That was really my interest. I love, very passionate about what I do. Mm-hmm. However, at that time, I started a business to do a part-time while I was playing water polo and swimming at Fresno State. Now, my degree was in construction and finance, and eventually I wanted to go that path. It's something I'm very, very passionate about. But during that time, I started cleaning buildings, and I was broke at the time, so I got a few clients at $63.63. My third client was Spano Enterprises at $210. Pat Rogers Associates, Double B Produce. I remember all these names. That's how I got my first $800. I built that company up over 17 years to about 500 employees in 3 different states.
Wow.
Facilities maintenance for Target, Mervyn's, Albertsons, Smart and Final, PetSmart, you name it. We did it. Exterior parking lot sweeping, street sweeping, pressure washing, graffiti removal, trash removal, interior janitorial. So I sold that company. I was in a car accident. I never really liked that company, to be honest. I was in it for 17 years. I didn't enjoy it. What I didn't enjoy was 7 days a week, 24 hours a day, very hard labor intensive lives. Never really liked it. Mm-hmm. But my passion is lending, finance, investor rehab, et cetera. It's a really great line of work. And so what happened is I was in an auto accident. It was a very bad accident, ended up in trauma with my 3 kids. And I decided in 2006 that I no longer wanted to spend the rest of my life doing something that I did not enjoy, which was the facilities maintenance company. I sold that facilities maintenance company with 500 employees to a private equity firm out of New York. And then I started ZINC, Z-I-N-C. My kids' names are Zachary, Nicholas, and Cameron. I needed a vowel to make a word out of their first initials.
Okay.
A didn't work because that'd be Zank. And O didn't work because that'd be Zonk. So I came up with the Zank. The I and my 3 kids' initials was the only word I could come up with that made sense. I started ZINC Financial. And so what I did is I got into, I'd done some multifamily repositioning and some things of this nature, probably in the late 90s. And so in the early 2000s, I started fixing and flipping distressed properties. What's a distressed property? It's a property that's probate, fire damage, water damage, REO, a bad rental, a drug house, or any of these things are we've all lived in a neighborhood where that's that house. There's one in every spot. And so I started fixing and flipping properties and did very, very well at it. I've done about 100 million of that. And then so in 07, I started lending. Who did I lend to? I lent to real estate investors.
Mm-hmm.
And so this is why I like debt funds. This is why I love my debt fund. We loan money to real estate investors with prime credit, with good backgrounds that simply need more cash in order to complete the transaction. We're not a subprime hard money lender. We're a private money lender. This is an excellent vehicle for wealth creation. So our borrowers are good FICO people. They have money. They just need more of it in order to buy that distressed property, to reposition it and resell it for profit.
Mm-hmm.
So my investors in my ZINC Income Fund benefit from this. They put money into the ZINC Income Fund, our debt fund, and then that money is used to lend out to good FICO borrowers who buy distressed properties at the lowest point in the neighborhood, reposition those up to conventional standards, so that they can be sold on the open market to a first-time home buyer. The reason I like this is it's kind of I call it my 4-win strategy. My borrower wins because our average borrower makes between $20,000 and $70,000 on each transaction. So they make money. They bought this old drug house, pulled up a dumpster, they cleaned it all out. And then the first-time homeowner, they love it. They got a newly rehabbed house, brand new, with new flooring and new appliances in this nice established neighborhood. They win. I win because I make money on the deal, and then my investors win in the debt fund. ZINC Income Fund is a debt fund, and how that works is they put money in there, and instantly, day number one, there's cash flow. Why? Because these loan instruments are making their payments every single month. We have less than a 1% default rate and less than a 1/8 of 1% loss ratio.
Wow.
Yeah, it's really, really strong, and it's strong because our fund only loans money to entry-level homes below the median cost of housing with a strong sponsor that put down 20% of their own money with strong credit. That's our borrower. So my debt fund, I think, is doing well. We produce returns of 8 to 9% with cash flow instantly day number one, with collateral we all understand. I'm not in beehives or energy stocks or oil wells or all this stuff that God forbid, some of these currencies that are out there. I don't believe in any of that. I don't understand it. I know this. I understand an entry-level home on a neighborhood that we're into at 80 cents on the dollar. So that works well. Debt funds are good because they provide instant cash flow on day number one, coupled with excellent protection of principal. And so with a first lien position, we have that built into the fund. I can talk a little bit.
Let me go back there. I want them to, because I want to go back. Like I always tell people, success leaves clues, right? So what I hear is you ran a business, right, for 17 years. So, business is business. So you figured a lot of stuff out. You successfully had to find, renovate, and sell hundreds of millions of dollars of property. So all of that skill stacking, I call it, has led you to where you are today, right? And then, because one of the things that we talk about, Todd, is that what I call the 3 rules of investing, and I hear that in your story, right? So invest. Rule number 1: invest in what you know. Okay, or invest in knowing. But right now, invest in what you know. My second rule is invest in what you can influence the outcome of. So you're, in terms of the debt you're buying. When you did the properties, because you make money when you buy, you've got good borrowers. So you're investing in what you know, you're investing in which you can control, because you could control who you lend to as a business owner. And then the third rule, Todd, is that you don't chase returns. So we teach people don't chase returns. So I want them to see that from a business person, successful investor, that the rules, the principles don't change. And so I heard that, and I wanted to bring that out in your story.
You have mentioned 3 very pillars of how I think. You mentioned invest in what you know, invest in something where you can control the outcome, and the third one was protection.
Don't chase returns.
Well, yeah, here I wrote down protection because this is my philosophy.
Yeah.
it differs slightly in yours, only in order. My first objective is protection of principal, irrespective of yield.
Mm-hmm.
Yield looks really great on paper and on a spreadsheet, but if it's not executionable, I don't go there. So your number 3 is really my number 1. Protection
Okay.
of principal is key. Protection of principal is key without the relevance of yield.
Yeah.
So we are exceptionally protected because we have the highest level of security available to us in the United States. We have a first position lien on a piece of real property, fee simple ownership, for which we have the rights to that property in a foreclosure within 90 days if the borrower defaults. That is exceptional protection. It's the highest level available to us in the United States. It's not available in other countries. Other countries, you lease it. The government really owns it. I mean, Cuba, they own everything. We have fee simple ownership in this country. We own that parcel. With that parcel, we have a lien on it. The only 3 things that come above us are taxation, eminent domain, and a thing called police powers, which enables the county to come in and take your property in the event you're doing something illegal, like a drug house or a prostitution ring, or the building's going to fall over on the neighbor.
Right.
Other than that, we have that protection. We have that protection absent 3 small things. That's my number 1 thing. The yield is a tertiary factor. Number 2, own, invest in what you know. Man, I wish I knew in my 20s what I know today.
Mm-hmm.
I have done some crazy stuff in my 20s, man. These get rich quick. Gosh, do you remember the whole web thing back in 05, .com, invest in all that? I did all that stuff, man.
Yeah.
In the late 90s. I'm in my 20s and, investing in all that stuff. And I don't know it. I didn't understand it. I never should have been in it in the first place. So I only stay in the lane that I understand. You say invest in what you know. That's your number 1. That's my number 2. Stay in your lane.
Mm-hmm.
Stay in your lane. I have fixed and flipped 100 million. I've lent $1 billion. I know my space very well, but that's all I do. I don't get into grocery store lending. I don't do agriculture. I don't do these other things. I have my money fully invested in the fund, all of it. And my family's all in it. The pastor of our church is all in it. These are all friends and family. So the point is I have to be exceptionally careful in where I place that. Only invest in what you know. I know distressed housing below the median cost of housing in the 40 states that we operate in. So I tell people all the time, why are you getting into this? Do you know anything about it? I get these calls probably once a week. Hey, Todd, I know this really good deal. And it's usually a pitch, and it's usually a scam, and it's usually a pyramid scheme. Look, first of all, you have no security.
Right.
You have nothing. You're investing in an idea, very lofty. Do you even know anything about this? And they only know what they've been told per the pitchman or the salesman.
Right.
So I don't like that. Your number 1 is invest in what you know. That's my number 2. Protection of principal without respect to yield is my number 1. My next one is stay in your lane. Invest in what you know. And then finally, you talk about control. I think that's extremely important. We can control our destiny in this. We control our loans. We control the FICO. We control how much we're going to lend. We have full control over that piece of collateral and that borrower. This is actually really important. Most people don't know this. Our deed of trust is 45 pages long. Just to give you an idea, Fannies and Freddies at the government level, it's about 16 pages. Our promissory note is 13 pages. The government's on a Fannie FHA loan is about 3. We have extensive business purpose lending documents, extensive knowledge on this industry. So we have a lot of control over what we lend on, how we lend on that, who we lend to, and controlling the outcome of that, because really we have the keys to the kingdom on that lien. And so
the key is you got a really strong underwriting criteria. So you're not risky. You're not trying to be risky and chase returns and
I am risk averse. I have all of my millions in my fund. If there's a point to anybody to hear on this show, I posted $500,000 in cash in our fund. Our compliance director in Veravest up in Oregon holds that money. I am in a first position loss over my investors. I have $500,000 posted cash. No investor ever loses in my fund without first penetrating me and that money that I've posted. So I'm very risk averse. I only lend money to well underwritten, well documented, well positioned borrowers. Credit, cash, and collateral. All 4 of those things are very, very critical to controlling the outcome of that transaction, to make sure that it's successful. when borrowers say, "Oh, I'll pay more interest or I'll pay more fees," that sends hair up the back of my neck. I don't want more. Believe it or not, I don't want more interest. I don't want more fees. Our fees are set. Our interest is set. I don't want that. The fact that brokers or borrowers would be willing to pay that much more is a problem, because that tells me there's more risk in the transaction. Our
Right.
average credit borrower is a 710 FICO. The average borrower is 20% down. The average borrower has great exposure to the industry. These are solid performing assets and solid performing borrowers. So we control, as you mentioned, control. Absolutely. I don't want to invest in something I don't know, that I
Right.
can't control, and I don't have the protection of principal. And with the debt fund, which is what we operate here, we have that protection of principal. It's at a fair and reasonable yield, 8 to 9%, with a 20% tax deduction on those earnings. We can control the outcome with solid underwriting, good credit, good position borrowers with good cash down, and finally, we really don't chase yield. I mean, we really don't. I know where the yield's going to be for where we're at, and I don't want higher yield, because with higher yield becomes more risk, and I'm not interested in losing that principal.
Because rates are a function of risk that
Absolutely.
or the cost of money, and so most people think risk as the probability of gain, but I view risk as probability of loss, right? So you want to mitigate risk, right? And one of the things what you described is because people will say investing to me, and I'll say, well, let's talk about what that is, because I really teach people to save so they have the capital to work with you, right?
Invest.
Right, to invest. You got to save first, right? And so but I'll say, look, I'll say, well, have you ever heard of Warren Buffett? They go, yeah. I said, have you heard of Benjamin Graham? They go, like 80%, no, not really. I said, well, he says an investment is something upon thorough analysis where you put your capital in, where you have safety of principal, right? And a reasonable opportunity to make a profit.
Correct.
And
That's the
doesn't
key
fit that
term.
definition, you're speculating.
Reasonable opportunity to make a profit. What is reasonable?
But your principal's safe, right?
Principal
And so most you can't. So now let's go back to, because we talked about you don't really love these. So why debt funds, which is what you're talking about, versus tell them what an equity fund is in today's market, and let's contrast them. And then what I want you just to set it up, I want to talk about, because most people get in those things, but they don't understand what due diligence is and how to do that. So I want to kind of tackle those one too.
So I'm going to first talk about, I guess, a debt fund versus an equity fund, and why I prefer debt funds, which is what I have. And then I'll talk about some due diligence on that. And number one, the equity funds as I know them, I've had friends and family that have invested in these equity funds. And they're usually broadcast like this: we're going to buy this complex. We're going to buy this center. It's going to be a 7-year hold. We're going to do all of these things to it to make it more value and create value. And then our exit strategy in 7 years is to refinance it or sell it or liquidate. And then we're going to make a bunch of money. The reason I don't like equity funds is because they only work for long-term holds. They only work with, you don't get any cash flow. And a lot of things have got to happen and go right for you to hit the pro forma objectives that they have so eloquently put in that sales brochure. So I have a lot of friends that have put money in equity funds. They can't get out of them. They're in them for 6 years. They haven't made a dime. The shopping center didn't quite get to where they thought it was going to get. The vacancy factor is still low. They weren't able to repaint it. They couldn't pave the parking lot. All these things start happening. The equity fund of owning a certain class of assets sounds tempting. And it also sounds tempting that we're going to make 20%. We're going to hold these assets, and we're in an equity fund, and look at this brochure. It's 19 pages, and look at all the wonderful things that are going to happen here. And we're going to make 20%. And I have never met a person that's gone into one of these funds that's held for 6 and 7 years that has gotten what the pro forma said they were going to get. And once you're in, you can't get out. You've got to see that property through to 7 years, and try to get these things to happen. And it's just very hard. They often almost never actually hit the hurdle that they say they're going to hit in that presentation. You don't get instant cash flow. You're at the whim a lot of other things that are outside your control, the county, the state, permits, vacancies, economy, all these other things.
Right.
That's the equity fund as I know it. And I'm not a fan of them for that reason. I can't control things. I have to wait 7 years to try to make money. It's not instantly cash flowing. I don't even know what the true value of that shopping center is because it's dependent on so many factors. Very illiquid. What are you going to do with a shopping center? That's half vacant. It's really, really tough.
Right.
My debt fund. Let's talk about that, and then I'll talk about a little bit about due diligence. My debt fund's instant. You put money in, and you got cash flow that day. Why? Because we're a debt provider with first lien positions, and so that cash flow is day one. It's instant. We know the value of the collateral at any given moment because our loans are short term. They're only 9 months. They're only long enough for that person to buy the distressed property, fix it up, and then resell it to an FHA first-time homebuyer. So we have an appraisal on everything in our debt fund. All the appraisals are relatively current because our loans are only 9 months, and all of them are performing instruments. They're performing immediately. They're all performing with good borrowers, with good credit, and so we have cash flow day number one. And we have tax benefits, a 20% tax deduction on the earnings. And it's liquid. If you need out, you can get out because our loans are only 9 months. So it's not that hard. The loans are churning where we always have cash available to either lend out or somebody redeems. So
you can get it out before I'm sorry to cut you off. Before 9 months, like say 2 months in, something happens. Is it like, what's the time frame for that?
We have our PPM actually calls for a year in the legal documents because and here's why. In the event of a calamity in our country, we have those loans out there. We're not able to run.
Right,
So if there was something that was monstrosity wise, the stock market crashed, there was a terror attack, we cannot liquidate everybody because we have the loan. So there is, technically speaking, there is a year.
I mean, I was thinking that like you should even consider this if you don't have liquidity, right? So it's not as illiquid as an equity fund,
100%.
but you need to have a longer term, at least a 1 year perspective. Yeah.
Because if there was any kind of real true stress on our financial system in our country, we'd obviously have to work through these loans in order to get everybody taken care.
Plus, you have to be a credit investor to let me just put that out there so that we can let them know whose ears should be perking up, because your ears should be perking up on this. But Todd is looking for a credit investor.
Our fund is a Reg D fund. It is registered with the Securities and Exchange.
Love that.
Yeah, very, very important. We are watched and audited by the federal government at the Securities and Exchange back in Washington. Your equity fund is simply an LLC that guy went out and bought some properties. You don't know what you're ever going to get. We are watched by the federal government. We have a Reg D fund that is open to accredited investors. What are accredited investors? Accredited investors are investors with $1 million of net worth or $250,000 in earnings. That's what accreditation is by the federal government standards. So those are the people that can participate in our fund. They have to have $1 million in net worth or $250,000 in income earnings. But our fund is. Can I touch upon the due diligence? Would that be?
Yeah.
So our fund or debt fund, which is instant cash flow with high security, is registered with the SEC. We have to be audited. We are audited by Spiegel, one of the largest fund auditing CPA firms in the country. We are audited for compliance, which is different from financial, with Verivest, one of the largest fund compliance companies in the nation. They do, I think, close to 200 funds for compliance. And finally, Jurassic Law down in Irvine watches over us for the legal aspect. So our fund is different, again, as an equity fund. An equity fund, everybody puts money into the LLC, and the guy goes and buys properties, and he's going to see what he can do with them over the next 7 years, and hopefully everybody will make money. Ours is a debt fund. We get instant cash flow day one, excellent protection of principal by a first position lien secured against the collateral. We are registered with the Securities and Exchange Commission. We are watched by the SEC. We are audited by Spiegel, one of the largest CPA firms in the country. We are compliance driven by Verivest, one of the largest operators in the country out of Oregon. And finally, legal is handled by Gerasi down in Orange County. So we're heavily watched on a periodic basis and heavily monitored to make sure that what we present to our investors is actually what's occurring. And so we've had no problems ever in my history, and no investor in our fund has ever lost a dime. This is a track record that we're extremely proud of. And I don't know that you can beat that and get returns of 8 to 9% with a 20% deduction on the earnings, on what comes from the fund on your federal tax return. President Trump, if I could share this with you really
Sure.
quickly, President Trump in 2017 signed into law some benefits for mortgage funds with a sub-REIT feature. And so we were able to do this. It cost me about $200,000 in legal, but we were able to do this and get it approved by the SEC. So our mortgage fund actually has a sub-REIT built within it. And that allows for 3 super duper tax benefits. Number one, all of the income earned within our fund is a 20% tax deduction on the federal level. Number two, irrespective of the fund and all of its income being earned in California, if you live in another state with state favorable tax rates, you're taxed in the state that you live in, irrespective of that income being earned in California. So if somebody lives in Texas, invests in our fund, they're taxed as though they're taxed in Texas at 0 income tax.
Right.
Versus California, even though the income's made here. And then the third item that President Trump signed in is there's no UBIT tax on IRA. So if people put their IRA money in here previously, there was unqualified business income tax called a UBIT tax. Your IRA had to do a tax return and pay some kind of tax. And
really, okay,
yeah. And so that was changed also. So Trump changed 3 things for us, all favorable. Number one, 20% deduction on all earnings. Number two, if you're in a state with favorable tax treatment like Nevada or Texas or wherever, Florida, and you invest in our fund and it earns its income here, you're taxed in the state where you reside. And then number 3, your IRA money in here is no longer subject to a tax return and UBIT tax. These are 3 very favorable things, only available to a debt fund like us that's structured with a sub-REIT, again, heavily monitored by the SEC, heavily audited and watched both for compliance as well as financial reporting. So I think that's something good.
That is fantastic. Are there any scenarios where because I'm just thinking about things people would think about: recession, a downturn in the real estate market, higher. Right now rates are not, they come down, but they're still higher than they were a couple of years ago. Does any of that affect your business or your business model?
I could talk all day on this, but I will share with you that I'm very heavy in metrics and analytics. I get my data from 2 sources: the General Services Administration, the National Association of Realtors. I spend thousands and thousands of dollars to get my data from the GSA. High level, what I'm doing is I'm tracking mortgage servicing across the country. Mm-hmm. It's a 160-page report. I pay a lot of money for it. I'm going to dumb this down to a very simple process. What I'm looking for is stress points in mortgage servicing, because that's one of the first things that starts to occur when we start to have housing collapse. I look for calls for forbearance, for foreclosure avoidance, pick a payment. I can't make my payment. Can I have it? Whatever. I look for the calls that come into the calling centers through the GSA that are monitored to see if there's any what I call stress points. I will tell you, as of today, as of last month, the stress point calls were at 0.04%, the lowest in 55 years.
Wow.
What we have is massive high-performing mortgages across the country. Again, I get my data from the GSA. Now, that is something different than what you'll hear on the major news channels, but they spin it differently. It's a spin. Housing's off 30% and interest rates are really high, but here's the facts. Here are the facts that I get directly from the data source. I don't do any of my research online, Google, no, God forbid a news magazine or the major news metrics.
Right.
So today we have about 90% of all mortgages are federally backed, FHA, Fannie, Freddie, whatever. These mortgage servicers are required to report everything through the GSA. I take that data. We have strong performance of mortgages. Why? I'll tell you why. Number one, they have a record low interest rate of average 3.5%. Number two, they have record equity. Number three, we have full doc loans out there compared to the '07 and '08, which were not documented loans.
Right.
So today I say this. From a mortgage per servicing standpoint, we're at a 55-year low for what I call stress points. There are no foreclosures coming. There are no defaults coming on existing inventory. Number two, I'm housing across the nation. This is very, very factual. We have a short and constricted supply almost in every state. With that, the sale, what I call absorption rates or velocity, absorption rates of homes that are for sale is very, very fast. The velocity is exceptionally fast. Average days on market right now in California as of last month was 28 days. 28 days. With the exception of 3 counties, all counties, the average property sale was above listing price. This is relatively consistent across the country. So again, I'm talking math. Ladies and gentlemen, I have the data. I have it in spreadsheet form directly from the source. Housing today is moving very quickly at a very low days on market. It's at or above listing price. And for the most part, we don't have a wave of foreclosures coming. My prediction, at least for the next foreseeable future, is entry-level housing is exceptionally safe. It's not going to come down in price at any time soon. I can't speak past a year or two, but I can tell you right now we have constricted supply. It is keeping prices exceptionally elevated. The median cost of housing in California has gone up 8 months in a row. So all of these things point to for me, a very stable asset class where I'm going to put my money. I like real estate because it's dirt. I can pull up with a truck and there it is. I don't, where other things like stocks and bonds have an element of risk or whatever that I don't particularly prefer. I have an actual hard asset that I can go to. So that's my market prediction. It's relatively stable, at least for the foreseeable future, and really relatively secure at this point. Now I should mention one thing. Is housing down? From a transaction standpoint, absolutely, it is down. It's about 25% down from about a year to a year and a half ago. But I will share with you that year and a half ago was a spike. It was a spike that we've never seen in about 70 years, and it was unsustainable. We had appreciation 10 to 12%. We had exceptionally low interest rate. We had a 25 basis point cost of funds at the Fed window. I called it back then. I said this will never, ever continue. It can't continue to go at 12%, 10%, 8% appreciation with free money. That fuels inflation or denominatization of our currency. So unless we want to demonetize our currency or deal with inflation, we will have to get back in tow. So yes, housing is 25% off from a year and a half ago, but that year and a half ago was an anomaly, grossly peak and not sustainable. Where we are today, believe it or not, is we're still not back down to normal. The graphs I have go back to the 90s, some cases the 70s. Our absorption rate or velocity for housing today, or price points, depreciation or appreciation, we're still not back to normal yet on days on market or things. So to my point, I think housing is very safe, very safe. We do not appear to be having the financial crisis we did from '07 and '08, which I could, that's a whole nother podcast on why that happened. But today I'm putting my money in it, and a lot of my investors are as well.
I think that also covered a lot of the due diligence parts. So let me break another point out. So
sure.
Just in business, what I want you to hear is how he understands his market, how he knows the numbers. So I want you to assess these clues for y'all business owners or would-be business owners, and again, my first rule, invest in what you know. That's knowing, right? And not hoping stuff works. He's got data, he's doing the research. Because as your knowledge goes up, Todd, what happens to your risk? Your risk comes down. So
absolutely,
there's no risk for this, and it's secured by real estate. And I'm talking you as a business owner, but the business model passes on that de-risking to the investor or the investor or lender.
Our risk is exceptionally nominal. We're highly regulated, highly audited, highly watched.
I mean, everything has some risk, but it's again, you want to mitigate. We just want to this because this show is for entertainment and education purposes, and you need to, get whatever to invest. So there's my disclaimer. So hopefully y'all all feel disclaimed, right?
People ask me at conferences. I was down there speaking in Beverly Hills in front of hundreds of people, and I did a speaking engagement also in San Diego. What's the biggest risk? What's the biggest risk? The biggest risk I see to what we do is something outside of our control that would cause our economy to spiral relatively quickly.
Right.
And I believe, because right now housing is exceptionally safe. There are not defaults coming. The velocity and absorption rates are relatively consistent. So all the numbers that I secure directly from the sources are performing to a very stable asset base. But to my investors, I say, well, what's the worst that could happen? The worst that could happen, and I predict this actually, is that we will have some type of calamity in our system that would cause us to decrease in value in all other asset classes across the board. What do you mean by that? War, a political disruption, a terror attack, another disease. Something's going to happen at some point that's going to cause the stock market, bonds, interest rates, unemployment, and housing to have a problem. So how do we avoid that? I tell my investors this. I said in Beverly Hills, you would have to be under a rock, because at the end of the day, if we have a calamity, which I predict we will in the next 10 to 15 years, of something that's going to disrupt everything, unless you are under a rock, you might get hurt. And so in that period of time where we do have something that's going to disrupt us outside of our control, I say this: I would rather be stuck with some houses that I can't sell than some stocks that went down 75%. I don't want to be in a stock where I'm seventh in line as a Class B shareholder to get paid back. Seventh. You're seventh in line. I'm first in line on a house because I have that first position lien. And so if something happens on our soil that causes a calamity, which I believe it probably will in the next 15, 20 years, maybe in your lifetime. I don't know how old you are. I'm not asking, but I think that, there could be a problem, and there'll be a problem across the board. Right. And so at least we got houses and rentals to deal with at that point. That's the worst that's going to happen, because other than that, it's a pretty solid, safe investment with a reasonable return, protection of principal, and heavily audited. I hope that helps a little bit.
That does. I mean, I wanted to, principal, I'll talk to people. I was telling people, you have to think, right? As another, I learned from a mentor of mine, Kim Butler, think from a macro perspective, right? So I love the macro talk, because if you know what's going on, you'll know what to do, right? And correct. So you need to be able to, what I call, seed up playing field, because once you understand a little bit about economics and markets and inflation, you can see kind of like the storm clouds forming. If you're paying attention and not being distracted by what I call bread and circuses, right? And like the Romans, like Super Bowl and the Grammys and and who slapped who.
I call it balloons and confetti. If you're distracted by balloons and confetti, then you're not a good candidate. I read metrics, data directly from the source, and I interpret that data, and then I make corrective action based upon that. So I see those clouds coming first because of my industry and what I'm at and where I get my data from. I get it directly. I'm usually out, 6 months. So in the event that I see the clouds forming, I see an uptick in servicing volume for foreclosure avoidance or whatever it's going to be. I see days in market creeping up to unsustainable levels. Velocity is slowing. I start to pivot. What do you do? Well, we slow. We require more down, better credit, whatever it is. We start tightening those reins on underwriting to make sure that myself, again, who's heavily invested in this, and my investors are well protected. So it's just a pivot. Will we get out of it? We won't get out of it, because I can't think of any. I'm on these shows all the time, and I speak at all these conferences. I can't find a better security instrument, a protection of principal, than what I do. I can't find it. It doesn't exist. Right. So if you want,
there is. Yeah.
I don't think there is. If you want that protection, which is really what I want, because I didn't inherit my money and I didn't win the lottery. I had to work for it very hard. I think we're in probably the safest asset class there is. And again, with a debt fund, we have the ability to have instant cash flow, as opposed to an equity fund that's going to wait 7 years. So I'm really proud.
Cash flow. See, what is an asset? So we say a definition of asset: someone puts money in your pocket, right? Immediately. And so you've got to train yourself. See, because if you have a bunch of assets, but they don't cash flow, it's not a good asset, right? And so You can't eat equity. I want money to go to the beach and stay at the
So
beach.
we have a rule here. We have a rule here. If it doesn't cash flow, we won't do it.
Right.
And we irritate a lot of borrowers. There's two things we look at. Number one, we do a return on investment on the after repaired value of the house if it's going to be sold to determine that there's going to be cash flow at the end of the rainbow. So what's that house going to be worth? What are you putting into it? Both of these are verified by an outside third party so that we know there's going to be cash flow at the end of the rainbow. Number two, when we do rental loans, same thing. We run a DSCR calculator to make sure there's going to be a debt coverage ratio of at least 1.315. What I'm saying is it must cash flow. We won't do it. I have loans every day that come here where we're protected and the value is high. I still won't do the loan because there's not cash flow. So this house has an appraisal for 1.1 million. At the end of the day, if I can't see a return, I call it the path to liquidity. If I don't see a path to liquidity where you're going to make money on the sale of this asset on a fix and flip, we're not going to do it, even though it's worth a $1.1 million. We're not going to get anywhere because you're going to lose money. And if you're going to lose money, you're going to be very unhappy. And I'm married to you, and then I'm going to be unhappy. Right. And same thing with rental loans. We just did a 6-unit up in San Francisco. I don't know what it was, 1.7 million. Boy, we dug deep. The appraisal was 1.7 million, but we've got to make sure that thing cash flows. And so we do a debt coverage ratio, a cap rate, and a variety of other metrics, because at the end of the day, these investors come to us and they're all excited and they want to do the deal. And this property's worth this, and I got it for this. No, it's worth what it cash flows. It's worth what we can see in cash flow. Because if it's worth 1.7 million and it doesn't cash flow by month number 3, you're going to get real tired of cutting that check to me and having negative cash flow on it. So for us, asset is only a value of providing cash flow to you that can be monetized and then compounded to grow your wealth. That wealth equals freedom. That's the whole trick is how do we get the cash flow, compound it to get to individual freedom and wealth. That's what this is about. So all of our transactions must have an exit strategy that is cash flow positive, or we won't do it irrespective of the value of the collateral.
Wow. So I want to say this. I wanted you to tell them how to find out more about you, the fund, where they can, check it out. I want to bring out because I want you to hear the mind of an investor. So one of the things that we teach, Todd, is something called Become Your Own Banker. But becoming, like thinking like the bank. See, I always tell people what I'm hearing and what you should be hearing is, because investors think asset is the house, but to the bank, the house is the collateral and the note is the asset. So I want just smaller people that are like how you pay attention to your money. That's what I want to pull out of that. Separate from, hey, look, this might be a good place to invest. I want to pull out the operational things that are going through your mind that really speak to me. And I want to make sure that's not going past people so they can hear, because I'm hearing what you say on like different levels. So it's brilliant. I just want to thank you for sharing that.
Absolutely. I think that's so critical. So critical to understand the collateral, the instrument, and how this works. It's very, very important at a very basic level out there. Ladies and gentlemen, the only way to get ahead is saving money, and you have to invest. You have to invest somewhere. You can't leave it in a savings account. You can't, or a checking account. That's not going to get you anywhere to freedom. Ultimately, we're on this earth for a very short period of time. We want to be to financial freedom quicker than later. You've got to save your money, and then you have to invest that money into something that is going to provide you consistent cash flow, reoccurring cash flow with protection of principal. It's so critical. And so right now, CDs and bank deposits might be doing well, but that's going to change. Yes. And so I think that's so critical to find something that has protection of principal, cash flow to build your individual wealth. This is not get rich quick. This is not we're not here to sell CDs and how or books. We're here. Hopefully, I provide some value today. This is what I do, and it's done very, very, very well. $1 billion is a big number, and that's the amount of transactions we've done. And we've lost less than 1/8%, which is absolutely negligible. We have 99 7/8 success rate on this. Out of $1 billion, we've lost about $300,000, which is nothing. So security, again, it all comes back to security, wealth generation, a fair yield. protection of principal is key. I think it's really important that your listeners understand that.
Absolutely. Todd, how can they follow out what you're going on, or reach out if this is or see if this is a good fit for them? What would you
Hey,
have them do?
My name is Todd Pigott at ZINC Financial right here in Fresno, California. Been doing this for almost 20 years. My phone number is 559-326-2509. ZINC Income Fund. It's our debt fund. It's doing exceptionally well. Excellent security, registered with the SEC. If you have interest, want to learn more, visit zincinvesting.com. That's Zinc, Z-I-N-C, investing.com. Or you can give David Sheets a call here at our office. He's our investor relations director. Be happy to answer any questions or talk to you or even teach you something. Even if you don't want to invest and you just want to learn, give us a call. 559-326-2509. I hope that you guys enjoyed what I had to add today and I contributed value to your program and your listeners. I really appreciate the extension you gave me today.
Yeah, no, you really did. And I thought it was brilliant. And Todd, I thank you. I appreciate your time today. And guys, so go out there. We'll put all of this information in the show notes. And so go out there, make it a prosperous day. And I hope we learned something. I know I learned something. I don't know about the rest of y'all. You weren't paying attention, but I have a page of notes over here. So I thank you if nobody else thanks you. So he gave you a bunch of writer downers and stuff that you could do if you qualify. But I think there's stuff in what we just talked about that you can apply to your individual investing or your individual businesses. And I wanted to pull out some of those lessons. So Todd, once again, thank you from the Practical Wealth Show. Hey, go out there and make it a profitable day, everybody.
We'll see you next time. Have a great rest of your week.
Are you ready to take control of your financial future? Hi there, I'm Curtis May, and I'm here to help you achieve your financial goals. Do you want to be the customer bank, or would you like to be the bank? Subscribe to our channel for regular updates, valuable insights from experts in different fields. You know, the name of the game, guys, is cash flow. Okay. You can't eat equity. And our goal is to help you build, we call it being a cash flownaire, which is passive income twice your expenses outside of Wall Street, where possible, right? Which is quite possible. And so if you're interested in learning more about our services, here is what I challenge you to do, or I invite you to do, I won't say challenge, is to take our financial freedom quiz. See where you are, okay? Don't wait any longer to take control of your financial future. Let's begin this journey together.